TechDaily.ai, your source for technical information. This deep dive is sponsored by StoneFly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyperconverged and VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com. Okay, let's dive right in. Today, we're really getting into the weeds of startup funding.
Yeah, specifically for those high-growth companies, right? The ones shooting for the moon acquisition, IPO, that kind of thing.
Exactly. Not your, profitable local bakery, though that's great too. We're talking venture scale.
And that's a crucial distinction right off the bat. The whole mindset is different.
How so?
Well, these startups, they're often prioritizing rapid, aggressive growth over immediate profit, sometimes spending way more than they earned for years.
It's a long game.
Totally. The bet is on a massive payoff later. Think about, many of the big tech names today. They burn cash for a long time.
Right, scaling up needed that fuel, which means external investment.
Almost always, yeah. And that's where funding rounds come to play.
Yeah.
Investors, they're generally cautious.
Understandably, high risk.
Exactly. So they don't just write one giant check. They invest in stages or rounds. Each round is kind of like a checkpoint.
A chance to see if the company's hitting its marks.
Precisely. Hit the milestones, you potentially unlock the next round. It de-risks it for them, step by step.
Okay, so let's walk through these steps. It usually starts with pre-seed.
Pre-seed, yeah. This is super early, often just an idea, maybe a very, very basic prototype, an MVP, a minimum viable product.
So what are investors looking for then? There's not much product yet.
It's almost entirely about the team. Do these founders have the vision, the expertise? Can they actually build this thing they're talking about?
Got it. Betting on the jockey, not just the horse yet.
You got it. Then comes the seed round.
Okay, what shifts for the seed round?
Seed usually happens after you've launched something, that MVP. You've got some initial users, maybe some early revenue, some signal, traction. Exactly. Now the pitch deck needs more. It needs proof that people are using it, that your early growth isn't just luck. Can you repeat it? Can you scale it?
So the seed money is for pouring gas on that initial spark.
That's a good way to put it. Accelerate that early growth. Build out the team a bit more. Refine the product based on feedback.
Okay, makes sense. Product's working, people are using it, now grow faster. What's next? Series A.
Generally, yes. Series A. And this is often seen as a major step up. It often implies you found product market fit.
And revenue becomes much more important here, I assume.
Oh, absolutely. Often companies going for Series A have crossed, say, the $1 million annual recurring revenue mark. It's not a hard rule, but a common benchmark.
And the metrics they look at?
Much deeper dives. What's your customer acquisition cost? Your CAC? What's your churn rate? How many customers are you losing? Lifetime value.
LTV.
Right. Healthy unit economics become critical. Investors need to see that the core business model actually works and can scale profitably, eventually.
Okay, so Series A is about proving the business model. Then we get into Series B, C, D, the alphabet soup.
Yeah, the later stages. By Series B, you're probably looking at companies in the maybe $10 million revenue range, give or take.
And the focus shifts again.
Definitely. Now it's about serious scale-up. Expanding aggressively, maybe internationally. You need to show you really understand your growth levers and have a clear, credible vision for a big exit.
An acquisition or an IPO.
Exactly. The stakes are much higher, the investments are larger, and investors are laser-focused on that potential multi-billion-dollar outcome.
So it sounds absolutely critical for founders to approach the right investors at the right time.
Oh, 100%. Don't waste your time pitching your pre-seed idea to a late-stage growth equity fund.
They just won't be interested.
Their check sizes, their risk profiles, their expectations, they're totally different. You need to find investors who specialize in your current stage. Do your homework.
Good advice. Now, something else founders need to wrap their heads around is dilution. As you take on this money, your ownership changes.
Right. Yeah. Dilution is, it's fundamental to the venture capital process.
Yeah.
Basically, each time the company sells new shares to investors.
The existing shareholders, including the founders, own a smaller percentage of the now larger pie.
Exactly. Your number of shares might stay the same initially, but the total number of shares outstanding goes up. So your percentage goes down.
And that can be significant over several rounds.
Oh, very significant. By Series B, it's not uncommon for the founding team to own less than 50% of the company they started.
Wow. That means losing majority control.
It often does, yeah.
Yeah.
And that has real implications for decision-making, board control. Sometimes Founders can even be replaced by the board if things aren't going well.
So that raises that fundamental question for founders, doesn't it?
The big one.
Would you rather own 100% of a, say, $10 million company or 10% of a billion-dollar one?
That's the trade-off, plain and simple. Building those huge venture-backed companies usually means accepting significant dilution over time. There are exceptions, bootstrapped unicorns, but they're rare.
And relying on investors brings other dynamics too, doesn't it? Potential friction.
For sure. You now have a board of directors you're accountable to. There can be disagreements over strategy, valuation in future rounds, when to sell.
And the risk of just running out of cash between rounds.
That's a huge risk. The valley of death. You raise your seed round, you burn through it trying to hit Series A metrics, but you don't quite get there before the money runs out.
And then you're in a really tough spot.
Very tough. So that initial funding, that pre-seed or seed, needs to give you enough runway, not just to build and launch.
But to actually hit the milestones needed for the next round, plus buffer time to raise it.
Exactly. Budgeting accurately and realistically is absolutely critical from day one. Underestimate your burn rate, and you could be in trouble.
Okay, so let's talk about how investors actually get those shares. You mentioned the company issues new ones.
Yeah, that's the most common way. The company authorizes and creates new shares specifically for the incoming investors in that round.
So the founder shares aren't taken away. The total pool just gets bigger.
Precisely. Like adding more chairs to the table, everyone's slice gets proportionally smaller.
And how many shares an investor gets depends on the valuation.
Correct. The valuation is the key number here.
How is that even determined, especially really early on?
Well, startup valuation, particularly pre-seed or seed, it's part art, part science. Mostly art early on.
Okay.
It's essentially an agreement between the founders and the investors about what the company's worth today, based mostly on its future potential and the risk involved.
So it's forward-looking.
Very much so.
Yeah.
It's a bet on what this company could become. There aren't usually significant assets or profits to base it on in the beginning.
And this agreed-upon valuation dictates how much equity the investors get for their money.
Exactly. And it also sets the stage for future rounds. Founders need to ensure they still hold enough equity after dilution to stay motivated for the long haul.
Right. If your stake becomes tiny, maybe your drive fades.
It can happen. Investors want highly motivated founders. Let's use that Facebook example again. Peter Thiel.
Okay, yeah, he invested early.
Right. $500,000 for 10%. That implied a $5 million post-money valuation, meaning after his cash went in, the company was deemed worth $5 million.
So the pre-money before his cash was $4.5 million.
Correct. Now imagine Facebook had, say, 100 shares before Thiel invested. That means each share was worth $45,000. $4, 5 minutes, 100.
Okay.
Thiel's $500,000 at that price per share bought him roughly 11 new shares. 500K, 45K gains.
Yeah.
So the company created about 11 new shares for him.
So now there are 111 shares total.
Exactly. And the original owner's 100 shares and now 100 out of 111, which is less than 100%. They were diluted. Thiel owns his 11 shares, which is his 10%.
That makes it really clear. But you said early valuations can be kind of arbitrary.
It can feel that way, especially pre-seed. Without revenue, what are you basing it on? It often comes down to the team's track record, the market size, the perceived hotness of the space.
And negotiation.
In negotiation, absolutely. Standard pre-seed rounds might be in the, say, $3 million to $5 million valuation range these days, but it varies wildly. It's often anchored on the ambition, the potential to be a $100 million plus company later.
What gives founders more leverage in that negotiation?
Competition. Having multiple investors interested, creating a bit of FOMO, fear of missing out, that's the best way to drive up valuation and get better terms.
A hot deal.
Exactly. If you only have one VC willing to write a check, they hold most of the cards. Once you hit seed and have some revenue, you might start seeing valuations based on a multiple of that revenue, but even then, it's still heavily influenced by growth rate and market potential.
It definitely adds complexity, having investors, reporting, board meetings.
Oh, yeah. It professionalizes the company, which is good, but it adds overhead. Compliance, regular reporting, justifying decisions to your board. It's part of the deal when you take external capital. And that valuation agreement is the starting point for that whole relationship.
You mentioned convertible notes briefly. How do they fit in?
Right. Convertible notes. They're a way to sort of kick the valuation can down the road, especially in the very early stages, like pre-seed.
How does that work? It's debt.
It's technically debt, yes. An investor lends the startup money. But instead of getting paid back with interest like a normal loan, the note converts into equity.
Into shares.
At the price set in the next qualified funding round, usually the Series A, often with a discount on that future price or a valuation cap to reward the early risk taker.
So you avoid arguing about valuation when there's almost nothing to value.
Exactly. It postpones that difficult conversation until there's more data, more traction, making the valuation discussion potentially easier or at least more grounded. It simplifies things early on.
Okay, so wrapping this up. For founders dreaming big, this stuff is non-negotiable knowledge, isn't it?
Absolutely essential. You have to understand the stages, what investors want, how valuation works, what dilution means for you personally and for the company. It's the language of high-growth startups.
It's a complex journey, clearly. From just an idea to hopefully massive scale requires not just vision, but serious strategic thinking about capital.
It really does. And while we've covered the basics, every startup's path is unique. There are always nuances, unexpected turns.
So as our listeners think about all this, the funding rounds, dilution, valuation, what's maybe one key thing they should really chew on?
I'd say it's truly understanding the implications of taking venture capital. It's not free money. It sets you on a specific path, a path demanding rapid growth and usually aiming for a large exit. Make sure that path aligns with your personal goals and vision for the company you want to build. It's a partnership with high expectations.
Great point. It changes the fundamental nature of the business. TechDaily.ai, your source for technical information. This deep dive is sponsored by StoneFly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyperconverged and VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com.